Hey there, and welcome to the deep dive. Today, we're cutting through the noise and diving headfirst into the Q1 FY26 financial results for Aditya Birla Money Ltd. Our mission: to unpack the raw numbers, understand the key movements, and extract the most important insights directly from their official financial statements.
That's right. We're looking at the unaudited financial results for the quarter ended June 30th, 2025. These figures were just reviewed by their audit committee and approved by the board of directors on July 11th, 2025, plus a limited review by their statutory auditors. So yeah, our goal is really to see what the actual numbers tell us about their performance this quarter.
Okay.
And just a quick note, for those maybe less familiar with Indian financial terms, when we say lakhs rupees, we're talking about 100,000 rupees. So, numbers in the thousands of lakhs mean figures well into the millions or even billions of rupees, just to give you a sense of the scale we're discussing.
Perfect context, thanks. Okay, let's start with the headline figures then. What were the key highlights for Aditya Birla Money Ltd. in Q1 FY26, thinking overall revenue and profit?
Right. So for the quarter ended June 30th, 2025, Aditya Birla Money reported a total revenue from operations of just over 11,270 lakhs rupees. And their profit after tax, or PAT for the quarter, stood at approximately 1,537 lakhs rupees.
Okay, 11,270 in revenue, 1,537 in profit. So what's the immediate story here, especially when we put them in context? How does this performance compare first to the immediate previous quarter, that's Q4 FY25, and then maybe to the same quarter last year, Q1 FY25? That's where we start to see the real trends emerge, right?
Exactly. So when we compare Q1 FY26 to the immediate previous quarter, Q4 FY25, which ended March 31st, 2025, well, we see a pretty significant rebound. Total revenue from operations is up, moving from just under 9,946 lakhs. But the really striking part is the profit after tax. It's up substantially from 932 lakhs. We're talking almost a 65% jump quarter on quarter.
Wow, okay, that's quite a jump.
It is. And the basic and diluted earnings per share, EPS, also reflects this strong improvement. It climbed from Rs 1.65 in Q4 FY25 to Rs 2.72 now in Q1 FY26.
Okay, so strong quarter on quarter. What about year over year compared to Q1 last year?
Right. Now, if you look at the year-over-year comparison with Q1 FY25, so ending June 30th, 2024, the picture is, well, slightly different. Total revenue from operations is actually down marginally from about 11,940 lakhs then. Profit after tax also saw a slight dip from the 1,636 lakhs last year. And the EPS for Q1 FY26 at Rs 2.72 is just a little below Q1 FY25's Rs 2.90.
So, okay, putting that together, what's the key takeaway? Looks like a really powerful bounce back from the immediate prior quarter, showing strong momentum. But that slight dip year over year suggests they haven't quite maybe returned to the performance highs of 12 months ago. It's a bit of a mixed bag.
That's a good way to put it. Yeah, significant short-term gains, absolutely. But still facing a small, let's say, long-term challenge compared to the previous year's Q1 peak.
Okay, that robust overall picture naturally makes you ask, where did that strength, that quarter-on-quarter strength, come from? Let's dig a bit deeper into where that revenue flowed in this quarter. What were the main sources, and were there any notable shifts or surprises?
Sure. So the company's revenue, it's primarily generated from three key streams. First, you've got interest income. That came in at around 5,537 lakhs in Q1 FY26, which is actually an increase compared to the 5,057 lakhs in Q1 FY25. So that suggests they're, effectively deploying capital or maybe benefiting from the interest rate environment.
Okay, interest income up. What else?
Second, there's fees and commission income. This stood at roughly 4,421 lakhs in Q1 FY26. Now, this showed a noticeable decrease from 5,883 lakhs back in Q1 FY25. Quite a drop there.
Interesting. Fees and commissions down.
Yeah. And third, we have net gain on fair value changes. This was about 1,312 lakhs in Q1 FY26, which is up from 999 lakhs in Q1 FY25. And this category is important because it includes both realized gains or losses from selling things like debt securities and also unrealized changes in value from their investments in debt and mutual funds.
That's fascinating. So we're seeing a clear shift in their revenue mix, aren't we? Interest income and these fair value gains are up year over year. But the fees and commission income, which I guess is often tied to market activity and brokerage, that's down significantly. What does this tell us about maybe the market they're operating in? And more importantly, how did this mix affect their operating and net profit margins?
That's an excellent observation, yeah. That drop in fees and commission income isn't just a number. It could potentially signal maybe a cooling in retail brokerage activity, or perhaps heightened competition in that space. This might be pushing Aditya Birla Money to rely a bit more heavily on its other income streams, like, its lending or investment activities, which kind of aligns with the increase we saw in interest income and fair value gains.
Makes sense. And the margins.
Right, margins. The operating margin for Q1 FY26 improved to 18.25%. That's a notable jump from the previous quarter's 12.72%. Good recovery there. However, it is still just slightly below Q1 FY25's 18.70%. And the net profit margin followed a very similar pattern. It reached 13.64% in Q1 FY26, which is way up from 9.38% in Q4 FY25, but again, just slightly lower than the 13.70% in Q1 FY25.
Okay, so margins improved quarter on quarter, but not quite back to year-ago levels. What about the expense side? Anything notable there?
Yeah, looking at expenses, total expenses for Q1 FY26 were around 9,232 lakhs. A couple of things stand out. Finance costs were 3,159 lakhs, which is up from Q1 FY25, likely reflecting higher interest expenses, maybe on borrowings. Employee benefits expense also saw a slight increase, up to 2,789 lakhs. But what's interesting is that fees and commission expenses actually decreased to 1,735 lakhs from 2,439 lakhs in Q1 FY25.
So that probably correlates with the lower fees and commission income we saw.
Exactly. It suggests maybe a proportionate scaling back or perhaps some efficiency gains in those related operations. And importantly, no exceptional items were reported this quarter. So these numbers, they reflect the company's core ongoing operations.
Right. No one-off skewing the picture. Okay, so that brings us to a crucial point then about how the different parts of their business are performing. Aditya Birla Money operates in distinct segments: broking, wholesale debt market, and then there's an others category. Given the shifts we've just discussed in revenue streams, how did each of these segments contribute to the overall picture this quarter? This is where we might uncover the true engines of growth or perhaps areas of weakness.
Yeah, this really highlights the power of diversification, especially in a dynamic market like this. Let's look at the two main drivers. First, the broking segment. Revenue here was approximately 8,132 lakhs in Q1 FY26. Now, while this is actually up from the previous quarter, it is a decrease from Q1 FY25's 9,989 lakhs. But perhaps more significantly, this segment's profit before tax, what they call the segment result for Q1 FY26, was only 569 lakhs.
Only 569 lakhs. How does that compare?
Well, it's a really substantial drop. It's down from both Q1 FY25, when it was nearly 1,500 lakhs, and even from Q4 FY25, which was around 745 lakhs. So even though revenue might have bounced back a bit sequentially, profitability in the broking segment clearly faced some serious headwinds, likely narrower margins, or, as we speculated, increased competitive pressures.
Okay, so broking profitability took a big hit. What about the other major segment, wholesale debt market?
Now here's where the story gets interesting. In stark contrast, the wholesale debt market segment showed truly robust growth. Impressive, actually. Its revenue in Q1 FY26 was around 3,064 lakhs. That's a healthy increase from both Q4 FY25, which was about 2,067 lakhs, and Q1 FY25's 1,879 lakhs. And the segment results, the profit for wholesale debt market was also very strong at 1,470 lakhs in Q1 FY26. That's significantly up from both the previous quarter's 495 lakhs and Q1 FY25's 742 lakhs.
Wow, so that's more than double the profit compared to last year's quarter.
Pretty much, yeah. What's fascinating here is how the wholesale debt market segment, well, it effectively picked up the slack from broking. It delivered incredibly robust growth in both revenue and profit. It became the clear and significant driver for the overall positive quarterly performance, especially compared to the prior quarter. It's almost like, they swapped one engine for a much more powerful one this quarter.
That's a truly striking contrast. So what does this tell us about the company's strategic resilience, maybe? It clearly shows the immense value of having these diverse revenue streams, doesn't it? Especially when one core area, like broking here, might be facing headwinds, while another, wholesale debt, experiences strong tailwinds. It's the wholesale debt market that's really carrying the torch right now, it seems.
Absolutely. It demonstrates that diversification benefit very clearly.
Okay, so beyond just the quarterly income statement, the real test of a company's financial health often lies in its balance sheet, right? What insights can we glean from their financial health as of June 30, 2025? Let's maybe look at a few key ratios.
Absolutely. A look at the balance sheet is crucial. So their net worth stands at approximately 25,207 lakhs as of the end of Q1 FY26. Now, Diving into some key ratios. First, the debt-equity ratio. For Q1 FY26, it was 6.58. This ratio, as you know, tells us how much the company relies on borrowed money versus its own capital, its equity.
And 6.58.
Hmm.
Is that good or bad? How does it compare?
Well, it's actually an improvement. It's down from both Q1 FY25's 7.72 and Q4 FY25's 7.11. So that suggests a decreasing reliance on debt relative to equity, which is generally seen as a positive sign for financial stability. Less leveraged.
Okay, lower debt to equity. Good. What else?
Then there's the interest service coverage ratio, or ISCR. It was 1.75 in Q1 FY26. This is a critical metric, obviously, for understanding a company's ability to meet its interest payment obligations from its earnings. Now, this is an improvement from Q4 FY25's 1.44, though it is a slight dip from Q1 FY25's 1.85. Still, 1.75 indicates they can comfortably cover their interest payments nearly, well, 1.75 times over. Signifies pretty solid financial footing for their borrowing.
Comfortable coverage. Got it. Any other key ratios?
Yeah, one more worth mentioning is the current ratio. This improved to 1.07 in Q1 FY26. That's up from 1.95 in Q1 FY25 and just slightly up from 1.06 in Q4 FY25. This ratio assesses short-term liquidity. Basically, do they have enough short-term assets to cover their short-term liabilities? An increase suggests better short-term financial flexibility. A ratio above 1 is generally preferred.
Right, better liquidity. And you mentioned leverage before. Any other indicator there?
Yes, the total debts to total assets percentage was 65.93% in Q1 FY26. That just gives another perspective on their overall leverage levels relative to their asset base.
That's a comprehensive look at the ratios.
Yeah.
I find it interesting, though, you often hear about things like debtors turnover or inventory turnover.
Yes, that's actually a really important point to note here. Due to the very nature of their business being a financial services company, specifically in broking and debt markets, certain ratios that are standard for, say, manufacturing or retail are explicitly stated as not applicable for Aditya Birla Money Ltd. Ratios like debt service coverage ratio, a different flavor from ISCR sometimes, debtors turnover ratio, and inventory turnover just don't fit their business model.
Right, no inventory to turn over.
Exactly. And stepping back for a moment, this really highlights how financial reporting and the relevant metrics can vary significantly by industry. What's crucial for analyzing a manufacturing company might be completely irrelevant for a financial brokerage like this. It's all about understanding what specific metrics best reflect the health and operations of this specific type of business.
Makes perfect sense. Okay, let's try and quickly recap our deep dive then into Aditya Birla Money's Q1 FY26 results. We've seen a really robust quarter-on-quarter rebound in overall profitability and EPS. That seemed largely propelled by the very strong performance of the wholesale debt market segment. This segment effectively compensated for, well, a much softer outcome in the traditional broking business, really showcasing the strategic value of their diversified portfolio. And furthermore, the company demonstrated clear improvements in key financial health indicators, like its debt to equity and current ratios, signaling, strengthening liquidity and maybe a decreasing reliance on debt.
Yeah, that sums it up well. And zooming out, looking at the bigger picture, these results truly underscore the importance of having those diversified business segments, especially when you're navigating the often turbulent waters of market fluctuations. The resilience and, frankly, the impressive growth shown by the wholesale debt market segment is a really significant takeaway here. It clearly demonstrates its growing contribution to the company's financial stability and its overall growth narrative. It's a clear message about where their current strength lies.
Absolutely. So as you mull over these insights, maybe consider this. In a financial services company like this, when one core segment like broking sees reduced profitability and another, like wholesale debt, steps up so significantly to drive overall growth, how might that kind of internal shift influence the company's future investment priorities, or maybe even its longer-term strategic direction? Where do they double down? That's perhaps a thought-provoking question for you to explore as you connect these dots.